Hello and welcome to AI Market News by LM. We are jumping straight into the action today because, wow, global markets are flashing bright red. The Japanese yen just smashed through a huge psychological barrier. And the big question on everyone's mind is, will Japan step in to stop the bleeding?
And there it is, 160. That's the number lighting up trading screens everywhere, from Tokyo all the way to New York. The US dollar is now buying 160 Japanese yen. Now, this isn't just another number on a chart. This is a critical level that has officials in Japan on super high alert.
So we're going to break down two key things here. First, why is this specific number causing so much chaos? And second, what are the odds that Japan actually launches a massive intervention to prop up its currency? All right, let's get into it.
Okay, so to really get why the yen is collapsing, we have to look way beyond just the currency markets. There's a much bigger story playing out on the world stage right now, and it's got everyone on edge.
So the main catalyst, based on market commentary, is the escalating conflict over in the Middle East. With Iranian proxies now getting involved, the fear is that this could spiral into a wider, longer war, and that's a huge threat to crucial global supply chains.
And we can see the immediate economic impact right here. I mean, look at this. Oil prices are just surging. Brent crude is pushing past $108 a barrel. And it's not just energy, industrial metals like aluminum are spiking too. This is what we call a classic supply shock, and it's fueling fears of both higher inflation and a slowing economy. Not a good mix.
So no surprise here, all of this uncertainty has investors just running for the hills. The Fear and Greed Index, which is a really key way to measure market sentiment, has plunged deep into extreme fear. What that tells us is that the main emotion driving the market right now is just pure old-fashioned anxiety.
So let's take a look at how this wave of fear is just ripping across all the different asset classes. You know, when a big risk-off event like this kicks off, we start to see some very predictable patterns as money starts to move.
In the currency world, it's really a tale of two extremes. Investors are dumping pretty much everything and piling into the safety of the US dollar. That's pushing the dollar index towards its best month in years. At the same time, the yen is just getting crushed. Japan's a huge energy importer, so rising oil prices hit them hard, and their super low interest rates make holding yen really unattractive right now. And the pain in the stock markets is, well, it's severe. The tech-heavy NASDAQ 100 is now officially in a correction. That means it's down more than 11% from its recent high. And it's pretty much the same story everywhere we look. The S&P 500 has been sliding for weeks, and Japan's own Nikkei index has tumbled by 5%.
So where's all that money from stocks going? Well, it's fleeing into the safety of government debt. We're seeing a huge rally in bonds, which pushes their prices up and, importantly, their yields down. The yield on the benchmark US 10-year Treasury has dropped all the way to 4.39%, and that is a crystal clear sign that the market is way more worried about an economic slowdown than it is about inflation.
All right, which brings us to the crucial question. With the yen in a total freefall, is the Japanese government going to do something about it? This is the multi-trillion-dollar question on everyone's lips.
We're already hearing the first warning shots. This is what's known in the biz as verbal intervention. Top officials are using really strong language promising bold action, basically trying to scare currency speculators. And this warning, it did cause the yen to bounce back for a bit, but the underlying pressure is still absolutely immense.
And look, these are not empty threats. Japan has a history of stepping right into the market to buy up its own currency. If we look back to 2024, when the yen was at similar levels, they spent trillions to prop it up. So, the key takeaway here is, they have the tools and they've done it before.
But, and this is a big but, here's the dilemma. This time feels different. They're not just fighting against speculators, they're fighting against a surging US dollar that's being fueled by global fear. It's kind of like trying to stop a tidal wave with a bucket. Can direct intervention really work when these powerful global forces are at play? So, what's next? The market is seriously on a knife's edge, and the next few days are packed with events that could trigger the next big move in either direction.
Taking a look at the calendar from investing.com, we can pinpoint exactly what we need to be watching. The economic schedule for the rest of this week is absolutely critical. Three big events really stand out. First, we've got German inflation data, which will give us a fresh read on price pressures in Europe. Then, all eyes are going to be on Fed Chair Jerome Powell. His words could literally supercharge the dollar. And finally, Tokyo's own inflation data will be released, which could pile even more pressure on the Bank of Japan to do something.
And that really leaves us with the ultimate question, doesn't it? Are we just looking at a short-term panic driven by geopolitics? Or are these the first tremors of a genuine stagflation shock? That's that toxic mix of stagnant growth and high inflation. The answer to that is going to shape the markets for months to come.
This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion.
Thanks for watching, and don't forget to like and subscribe for more updates.